April didn't bring the same shock factor as March, but it did confirm a shift. After a month where geopolitics abruptly reshaped the market narrative, April was about digestion. Markets spent the month recalibrating to a world where inflation risks are rising again, rate cuts are less certain, and geopolitical instability remains a persistent overhang. Let's start with a recap of April. Equity markets trended higher as investors became more desensitized to the closure of the Strait of Hormuz. The S&P 500 was up 9.4%, while the TSX was up 2.7%. This has narrowed the gap of U.S.'s underperformance. Year to date, the S&P 500 is sitting up 4.3%, while the TSX still leads up 6.1%. Interest rates were quiet and boring. The Canadian 10-year trended from 3.47% to 3.55%, while in the U.S., the 10-year moved sideways from 4.32 to 4.39. Not much to call home about. Staying on the interest rate theme, both the Bank of Canada and the U.S. Federal Reserve held their rate decision meetings last week. Both central banks kept their overnight rates unchanged at 2.25% here in Canada and at 3.75% in the U.S. Now, last but certainly not least, the roller coaster ride that is oil prices continued through April. The top of the range in March was just north of 110 a barrel in WTI, while the bottom of the range has been 84 a barrel. We're currently trending back towards the top end of that range at 106. Now, to be sure, oil has been range-bound, but we're not talking about an ordinary range. This one has been wide, and it's definitely been volatile. Within this landscape, how has Matco's investment platform performed year to date? Starting with Matco's opportunity strategy, which is up 15.8%, our global equity strategy up 6.4%, our Canadian equity income strategy is up 5.2%, Matco's balanced strategy is up 4.5%, while our diversified income strategy is up 0.3%. Now, each strategy is in second quartile or better in their respective investment categories, with 4 out of 5 of them being in first quartile. All in all, we're pleased with how our process is driving the platform's results. Now, let's dive into the headlines and developments that drove these market moves. Following the sharp escalations in March surrounding Iran, the resulting surge in energy prices, April was defined by more stabilization, but at elevated levels. As mentioned, oil remains near the top end of the range, and while the immediate panic around supply disruption eased somewhat, the market continues to price in a structural risk premium tied to the Strait of Hormuz. That matters because energy is no longer just a headline, it's feeding directly into broader inflation narratives. This brings us to the most important development in April, which is inflation expectations have in fact stopped improving. Now, after a multi-month trend of declining inflation data through late 2025 and early 26, the progress is clearly stalled. In some cases, we're beginning to see signs of reacceleration, particularly in energy-sensitive components. As a result, expectations for central bank policy also continued to shift. What started in March as a repricing became more firmly embedded here in April. The view that central banks would move quickly to ease policy has largely been replaced with a more cautious stance. Both the Bank in Canada and the Federal Reserve reinforced this message. The tone has shifted from when cuts will happen to if conditions will allow it. Central banks remain dependent, but the hurdle to cut rates has clearly moved higher, and the possibility of rates actually increasing now is real. As mentioned, both North American central banks left rates unchanged at their April 29th meetings. Also notable, Prime Minister Mark Carney announced the creation of a Canadian Sovereign Wealth Fund, the Canada Strong Fund. With an initial federal contribution of $25 billion, the fund is set to strategically invest alongside the private sector. Little details have been released, but this is a development we'll continue to watch as it unfolds. In practical terms, the higher for longer rate environment is no longer just a risk, it's increasingly becoming the base case. Equity markets reflected that uncertainty. After March's sharp drawdown, April saw better performance across both regions and sectors. Broad indices attempted to stabilize, but beneath the surface, the rotation we highlighted last month continued to take shape. Leadership does in fact remain in flux. Energy and materials continued to benefit from the commodity backdrop, while industrials held in relatively well. Defensive sectors like utilities and consumer staples also saw steady demand as investors looked for more stability. Meanwhile, areas that had led markets over the past year, particularly large-cap technology, struggled to regain momentum. This isn't necessarily a collapse in fundamentals, but rather a recalibration of valuations in a world where interest rates may stay elevated for longer than previously expected. In other words, the market is becoming less concentrated and it is becoming more balanced. Commodities remained a central driver through April, although with a little less volatility than in March. We've already touched on oil, but precious metals continued to show sensitivity to both real rates and to positioning. The extreme moves we saw previously began to moderate, but the broader message remains intact. Commodities are once again a meaningful force in all asset allocation decisions. At the same time, the growth outlook continues to soften at the margin. Higher energy prices combined with still restrictive monetary policy are creating a more challenging environment for both consumers and for businesses. While we're not seeing a sharp deterioration in economic data, the direction of travel is quite clear. Growth expectations are gradually being revised lower. This does leave us in a more complex environment. On one hand, inflation risks are reemerging. On the other, growth is losing some momentum. It's not a full stagflation scenario, but the balance of risks are becoming less favorable than they were just a few months ago. And importantly, the drivers of markets have changed. We have moved further away from the clean, predictable narrative of rate cuts and tech leadership. It is in a place that is more fragmented environment, one influenced by geopolitics, energy markets, and a broader set of economic drivers. Periods like this tend to challenge concentrated positioning and reward properly built portfolios. They also tend to produce more volatility, but with that, more opportunity for disciplined investors willing to look beyond the short-term noise. So with that in mind, how did Matco adjust our portfolios? In Matco's global equity strategy, we removed a technology name from the portfolio while also trimming an energy holding. Both portfolio adjustments fall into the risk management category. The technology name had been underperforming, while the energy name had had a strong run. Both prudent for unique reasons to both their business model and our original investment thesis. The opportunity strategy was quite active in April. We invested in Blackline Safety, a local Calgary company that specializes in worker safety technology, back in January 2024. The company was acquired by a leading technology investment firm, Francisco Partners. Our process around acquisitions is to avoid deal risk, so once the deal was announced at about a 30% premium, we exited the position, which had more than doubled within our portfolio. Further highlights were the addition of a private global real estate technology company, the addition of a transport technology focused on roadway tolling systems, and the addition of a startup company in the defense industry. Now, all three of these additions are private companies. On the public side of the portfolio added a minerals exploration position and a defense company that came to market through an initial public offering. Lastly, we trimmed a Saskatchewan-based energy holding while completely removing a global gold company. Although the noise in markets remains high, opportunities are clearly still present when coupled with proper due diligence. Now, within Canadian equity income strategy, activity was lighter. We removed Boyd Group, which had underperformed in the portfolio, while utilizing the proceeds to add to a portfolio company in the asset management sector. If you recall from March, Matco's diversified income strategy was quite active, primarily through a butterfly trade. This portfolio adjustment increased our concentration in the 8 and 9 year part of the yield curve, which has performed well. In April, there was no activity to speak of, as new issuance in the market was on the lighter side. Now, last but certainly not least, within Matco's balance strategy, we did add to our position in the CMLS mortgage solution. This addition will take us closer to our 3% target for that position. The CMLS mortgage delivers a yield in the mid 7% range with very low volatility. Stability and income are valuable in this environment. We spent the month of April in the cockpit making subtle course corrections to keep portfolios on a steady flight path. Despite the pace, I did manage to get through another monthly read. In April, I revisited the Essays of Warren Buffett, Lessons for Investors and for Managers, written by Lawrence A. Cunningham. I tend to come back to this book about every 3 to 5 years. It's not exactly a page turner, as it does read a little more like a well-organized textbook than a traditional narrative. But that's part of its value. The essays distill decades of thinking from Warren Buffett on capital allocation, corporate governance, and long-term investing, all grounded in clear, rational decision-making. What stands out for me each time I pick it up is how timeless and consistent the principles are. Focus on quality businesses, think like an owner, avoid unnecessary complexity, and let long-term compounding do the heavy lifting. It's a practical, no-nonsense, no BS refresher that reinforces what disciplined investing looks like. One of my top quotes from the book, time is a friend of a wonderful business and the enemy of a mediocre one. You can't turn a toad into a prince just by kissing it. Now, the point is simpler than the metaphor. Buffett prefers buying high-quality businesses at reasonable prices than investing in weak ones and then trying to fix them. It's a reminder that selecting your investments matters more than the optimism you have in outcomes. It's worth mentioning that these high-quality businesses must be accompanied by best-in-class management teams who have proven to be strong allocators of capital. If you're a sophisticated investor, accountant, aspiring investment professional, or just have a keen interest in deep business thinking, this book is a must. Now, if you're less inclined to look under the hood and uncover what works when it comes to business and long-term investing, honestly, take a pass on this one. Overall, I did give it a 9.2 out of 10. There's definitely a reason I've read it 4 times now. That said, it's definitely not for everyone. As a teaser for next month's read, I've actually received a book recommendation from a client. He, in fact, delivered it to me personally. Though I haven't started it yet, I've been told it focuses on how the private sector stepped into the public service during wartime. I am very much looking forward to this one. That's it for this month's edition of Read Between the Lines. Stay tuned for next month and happy reading.